Good morning. Welcome to the Wednesday webinar. Hope you are having a fabulous morning. We are back with Tim Swoboda from Silac. Tim is going to be talking more today about everything that Silac has to offer, kind of a high overview on some of the packages that they have, and hopefully you guys can write more. Also, don't be afraid to reach out to Tim. Tim is great about getting back to you and making sure that you have everything you need in order to write the Silac products. And guys, we have ramped up our annuity production like crazy, and it's only going to get bigger. And so Monty McCurley is the head of that here and Secure, and he is doing a great job with it. So if you have any questions, please reach out to Monty or Tim, and they can help you out. But without further ado, let's hand it over to Tim. Tim, welcome, buddy. Appreciate you coming on here, and take it away.
Awesome. Thanks, Dallas. Thank you for having me again. Well, good morning, everybody, and good morning, Secure Insurance Group. Hope everybody's having a great week. So this is going to be part two of the sequence, I guess we could say, of the training for Silac. So just real quick, what we're going to do today, this is what we're going to talk about. We're not going to go into the product in depth. We did that last week, but we are going to go over some quick highlights just to give a refresher of how our products work. We're going to go over some index highlights just as a refresher, but more importantly, we're going to look at positioning and case studies on our products. So to start things, I got to mention our MIGA. Our MIGA is growing, and it's becoming extremely competitive, especially in the 2-year space. There's not a lot of carriers that have a 2-year MIGA out there. All right. Just so you know, our MIGA does go up to age 90, and here are the rates. Okay. So on the left, you got Secure Savings, which is at 2.35 on the 2 and 3.25 on the 5. Now the Secure Savings has all of your free withdrawals included. Okay. Now on the right, you have Secure Savings Elite. This is where the rates are a little bit higher. Now it's a little bit higher because there's no free withdrawal provisions in the contract. This is what I call your Build-A-Bear annuity, because you can add in your free withdrawal provisions, as you can see on the bottom of your screen, at a rate reduction. Now pay close attention to the death benefit. They are different. All right. Secure Savings Elite is cash value at death, and Secure Savings is account value. But both of our contracts, actually all of our contracts at Silac, offer spousal continuation. Not a lot here. This is a great reposition of maybe some CD money, some low yielding interest rate money, so a client can get a guaranteed rate, especially on the 2-year chassis, or even a bond alternative. We know if interest rates go up, those bonds become less valuable, right? So with these, it's a great way to secure a rate for a 2-year period of time, or even a 5-year period of time. Now on to our Teton. As I mentioned last week, our Teton annuity was one of our very first annuities we brought to the table. Just some basics. Our 7-year contract on all of our FIAs go up to age 90. That is a very unique feature, because I know most index annuities stop at age 80 or 85. Now our 10-year stops at age 85, and also our 14 stops at age 80. $10,000 is the minimum premium to get started on any of our annuity contracts out there. All right. And we do allow additional premium on all of our index annuities for the first 12 months. Now, here's something to get excited for. These are the current rates. I want to show these again as I showed them last week, but take a look at this accumulation opportunity. Just on the fixed rate alone, 2.25 on a 7, 2.75 on a 14, almost 6% on the annual point-to-point with cap on the 7-year contract. And on the very bottom, we have our 2 proprietary indices that nobody else has, called Atlas and Ravenpack, well over 100%. One thing to note, all of our indexes are on a 1-year chassis, all right? So you don't have to wait 2 years. Those are 1-year participation rates on Atlas, Ravenpack, and 1-year cap rates that you see on your screen there. Now, another thing we do different, we have what's called the boost strategy. As you can see on the very bottom, the Ravenpack annual point-to-point boost is 1.25. What does boost do? Well, boost looks at what the index did and it adds to it. So if the Ravenpack performed at a positive 6%, We're going to take that 6, add 1.25 to it, and your clients are going to walk away with 7.25% with an interest credit. But better yet, that boost can turn a bad year into a good year still for your client. So in the event that Raven Pack didn't perform, and let's say it was down 50 basis points, and they were allocated to that Teton 7 with that boost of 1.25, your clients would still walk away with a positive interest credit because that boost is higher than what the index did on a bad year. So these are the non-bonus rates. Here are the bonus rates. The bonus rates for the Teton. Pay close attention to the Teton bonus 7. It is age banded, so 6%, 0 to 80, 3.5, 81 to 90, a lovely 8% on the 10, and a fantastic 10% on the 14-year chassis. Now the bonus does take a little bit of a wait to provide that big jump start to the contract. That's why the caps and rates are a little bit lower. Now, how do we position this? Well, let's take a look at a case study here. So Teton is really focused on accumulation opportunity. One big key feature with Teton, it has a cumulative withdrawal feature, all right? So if the client doesn't take any withdrawal, including RMDs, it can accumulate up to a maximum of 30%. That's a big chunk of change. So you're talking about a client who had some money and they're growing. They didn't take any withdrawals, and after 6 years, free withdrawal available to them. All right. But let's take a look at this accumulation story. So when you run an illustration with Silac, this is what you're going to see. On the top right, 6.8%. Wow, what is that? Well, I'm going to explain to you what that is. It is basically the first 10 years averaged out. But look at some of these interest credits. Remember, Teton is focused on very simplistic accumulation. This client wanted accumulation and might need a big chunk of change later in life. Well, Teton is the play for this client. But if you see, we have 1, 2, 3, 4 years of double-digit returns. We started this contract with $100,000, and at the end of 10 years, it grew to almost $200,000 without taking any form of withdrawal. Pretty simple story, but the story keeps going. It keeps growing. At the end of year 15, almost 280. And at the end of 20 years, we're looking at almost $375,000. So if your clients, or if you have clients that are looking for a very competitive, simplistic accumulation indexed annuity, Teton is the play, especially with that 30% cumulative withdrawal that is available to them if they don't take any withdrawals. Pretty simple story, okay? But we're going to switch gears here, and we're going to go to our Denali contract. Our Denali contract is one of our flagship products, all right? It is taking the industry by storm. Now, some basics on Denali. 7-year contract goes up to age 90, 10-year age 85, 14 age 80. Same minimum and maximum premiums that you saw on Teton. Now, Denali, before we get started, this is your free income rider annuity. That's right. None of our index annuities have any fees. So here are the rates for Denali. They are a little bit higher than Teton because it is accumulation focused for that income benefit, as I explained on last week's webinar. But look at that, a fixed rate of almost or over 3% on the 14-year chassis, over 6% on a 7-year chassis, and look at the proprietary indices down below with Atlas and Raven Pack. 135 on a 7, 145 on a 14, and capping out at 155% on the Denali 14. Now we do have a bonus line as well. So on the bonus line, all of our bonuses are age banded. So pay close attention to those issue ages because it is age banded, but there are the bonuses. Yes, the caps and rates are a little bit lower because of that bonus load that jump started the contract, but still some very competitive caps and rates, especially on a bonus contract. Now, as I mentioned before, Denali is focused on lifetime withdrawals. Just a real quick overview of how these lifetime withdrawals work. Everything is linked to the account value. since everything is linked to the account value, the benefits are real all the time. There's no phantom account. There's no fictitious account where a client says, hey, how do I get money? How do I get that money over there? Well, you can't have it until you turn on income, right? With Denali, the account value is the driver, so the client's benefits are always real, which gives us the opportunity to not have restrictions on the contract, such as a maximum roll-up term or a benefit cap. Now, we do have a 1-year wait before the client can activate income. And again, there is no fee for this benefit. But more importantly, we're going to look at some illustrations. And there's one feature that we've probably talked about a lot in our industry, but have very rarely seen it in some of these income rider products, and that is called Step Up. And we're going to go over how Step Up works in a couple of illustrations in a few minutes. Now, in addition to the income rider on Denali, we also have wellness withdrawals. Again, there's no fee for this whatsoever. So if a client cannot perform 2 out of the 6 activities of daily living, they can double their income on a single payout or 1.5 times on a joint payout for a maximum of 5 years. There's a 2-year wait before this benefit can be activated, but a great way to help increase somebody's income when they have the inability to perform 2 out of 6 activities of daily living. I want to stress this is strictly ADL driven. It doesn't matter where the client resides. It's just cannot perform 2 out of the 6 activities of daily living. I think of those activities of daily living as a bed contract, BED, CTT, bathing, eating, dressing, continence, toileting, transferring. Those are your 6 ADLs. If they can't do 2 of them, they can activate this benefit after the 2-year wait and get that enhanced income. Now, looking at some case studies, we have the first one. We're looking at Denali 14. This client was wanting to defer income for 10 years. They're age 60. They're putting 100 in, but they say, look, I want to build my retirement. I'm going to defer my income. I want something that grows, that can provide me with a guaranteed income stream, right? So they looked at Denali, and here's what Denali did with their $100,000. So we put $100,000 in. There's that lovely annual effective rate of 8.24%. But look at some of these illustrated interest rates. We have 1, 2, 3, 4, 5 years of double-digit returns. That is some major accumulation opportunity on this product. Now, remember, as I said before, everything is linked to the account value on this annuity contract. So the client was deferring income for 10 years. At the end of 10 years, their 100,000 grew to 220. They activated income, and they're going to start receiving 11,585. Don't forget about the wellness benefit. If they couldn't perform 2 out of 6 activities of daily living, this is showing a single payout. That income would double. 23,170 for the next 5 years. After 5 years, it would revert back to the original income amount and continue to pay out for the rest of the client's life. But let's go back to the income story. We started taking 11,585 out. But look at what happened after we took out some income on this illustration. The account value grew. It grew to 223,094. What does that mean? Well, that means step up is happening. Step up happens automatically because the account value grew. The contract will readjust automatically and see if it can provide a higher income. In this case, it did. So the client's new income that is locked in is $11,712. We go all the way out to year 20, age 80. This is really kind of neat because most income rider products, when you start taking income, the account value decreases pretty drastically. Well, we started taking income at age 71. We're at age 80. Remember, we started this contract with 100,000. These clients still have $280,000 left in their account value. They have taken out almost $140,000 from this contract, which means the total benefit is just under $420,000. That is accumulation and guaranteed income at its finest. Okay. Now, for those of you who say 14 years is a little too long, how does your 7-year contract perform? Well, I'm going to show you the same case study, but we switched gears and we're looking at the Denali 7 now. So on Denali 7, we did the same exact thing. You have your annual effective rate. We still have some years with double-digit returns. We put $100,000 in, and boom, the account value at the end of 10 years is $213,701 in this example. The client turns on income, $11,754, still very competitive with the 14-year contract. Don't forget about the wellness benefit. It is still on the 7-year contract. And did I mention that wellness benefit goes up to the max issue age of age 90 as well? But we still see growth opportunity with those high caps and rates, even after we start taking income. So the account value grew once again, and step up is occurring even on our 7-year contract. Look at that, $12,262 is the new income the client is going to start receiving. At age 80, their account value is still doing very well. It's still staying up there, $254,586. We withdrew $134,000 out of this contract, which means our total benefit is just under $390,000. So whether you're looking for a 14-year contract or a short-term 7-year contract for an accumulation or income play, especially with no fee, for increasing income, Denali is the play for those clients. Okay. Now, if they're looking just for maximum accumulation, you can certainly look at Denali for accumulation, since it does have the higher caps and rates, especially because the client is not paying a fee for that income rider. All right. So we got some opportunity there. And more importantly, since the account value has the opportunity to perform with those higher caps and rates, there's a very good chance, depending upon how it's illustrated and how the product performs based upon the indexing selection, that the client could receive lifetime income and there could still be money left for the beneficiaries in the account value. Now, we get asked this all the time. Tim, you have Teton, you have Denali. They kind of look like they, fight each other a little bit. Which one's best? Because I have this client. All right. I have Mr. Jones. He has 500,000. He wants to accumulate his assets without risking losing any money. So, there's the light bulb that goes off. We're looking at a Silac annuity. But here's the trick. He wants to access his funds with not only lifetime income, but in the event he has a miscellaneous liquidity need. So now we're kind of stuck, right? Which one works best? Because we got Teton with that, accumulative withdrawal feature, and we have Denali that has the lifetime withdrawal. Well, we're not quite sure. Well, I don't want anybody to get stuck saying they only can do one annuity, because we can split this client up. We can choose both. It takes a little bit extra ink, but that's okay, because we can put this client and split these funds with Teton and Denali, and this client can get the best of both worlds, because the Teton will give him that cumulative withdrawal feature, and Denali can provide this client with the lifetime withdrawal and the wellness withdrawal that he's looking for. If we do a side-by-side comparison on how they perform, let's look at the Teton 14. We put 250 in. At the end of year 6, his account value would grow to 387. Remember, he didn't take any withdrawal. And because that cumulative withdrawal feature caps out at 30%, he could take out a big chunk of change, $116,000. That is one happy daughter for one big wedding, right? I'm just kidding. But he has a big chunk of change he could take out if he needs it, since he didn't take any type of withdrawal, and it accumulated up to 30%. But let's look at how Denali performed for this client. He put the other 250 in Denali. At the end of 5 years, he could activate income, almost $20,000. If he waited till 10 years, almost $33,000. And let's say he waited all the way out to age 80. He said, look, I'm gonna live forever. In this illustration, he would have almost $98,000 in lifetime income. So again, think outside the box. We do not always have to choose one annuity. We can blend them. And Teton and Denali work beautiful together when you're looking at that type of client. Now on to our last annuity with Vega. Vega is our newest annuity contract. I want to give a quick overview of the concept of Vega, and then we're going to look at a real life case study of how Vega can help some clients in this current market. So with Vega, we've looked at Teton and Denali both have this account value. Well, Vega has an account value as well. And this is where the premium and the interest credits go in, which allow the clients to take their free withdrawals. This is where the cash surrender value comes from. This is where the lump sum death benefit comes from. But what's new with Vega is there's a benefit value associated with it. And the benefit value is the driver of this contract, which is where the premium and any type of bonus plus the multiplier of interest credits are credited to, which gives us, or which allows the client to activate one of 3 income withdrawal features: increasing, level, accelerated, which both increasing and level have wellness withdrawals, and also provide the beneficiaries the flexibility with an enhanced death benefit. Now on our bonus contract, we have a 35% bonus. There are the multipliers, and I'm going to show you how those multipliers work in a few other slides later. But a 35% bonus, that is not a premium bonus. That bonus goes into the benefit value, but a great way to jumpstart that benefit value for those clients. Now, if we took that bonus out, we didn't want to back into the contract. So on the non-bonus chassis, you're going to see that the multipliers are different. There's a different multiplier in deferral mode, and there's a little bit lower multiplier in the payout mode. But almost there's a 300% a multiplier on the Vega 14. What does that multiplier mean? Well, I'm going to show you an example. All right. Let's say the account value had a 4% interest credit. All right. Now remember, the benefit value gets that interest credit on top of that multiplier. So we take that 4%, we multiply it by 300. That means the benefit value is going to receive an interest credit of 12%. So there's a great story there to really accumulate that benefit value to grow that lifetime income pot for that client. This is just showing a quick example of the power of the multiplier, just quickly how it works. Want to run through it. But more importantly, since our annuities do not have any fees, check out this year. There is a bad year. 0% was credited. 300 times 0 is 0. But look at the account value. It did not go down. 0 is your hero, especially with our no fee contracts like Vega, Teton, and Denali. Now, as I mentioned before, there are 3 types of income withdrawals. Increasing is probably the leading withdrawal feature on this contract. The income will start out a little bit lower than the level, but it has the ability to grow over the years. Now, on increasing withdrawals, there is a 7-year wait before a client can activate income on the 7-year contract and a 10-year wait on the 10 and 14. But we need to pay close attention to those increasing multipliers, all right? That is how the income is going to increase over the years. Let's look at an example. All right, on the increasing withdrawal example, we're looking at Vega 14. We're putting $100,000 in, and we're going to defer for 10 years. At year 10, remember, there's a 10-year wait before a client can activate income. They're going to receive an interest credit of 2.81% in this example. We get to multiply it by that lovely 300% deferral multiplier, which makes the benefit value grow by 8.43. Our benefit value is $358,625. We apply the appropriate payout percentage, which the calculator does all for you, all by itself, and it's going to start generating income. The client says, hey, I waited my 10 years. I want to start taking income. Great, you can do that. $16,138 is going to start coming out of this contract. But guess what? The very next year, we're illustrating that the client may receive a 3% interest credit. What does that mean? Well, we look at the payout multiplier now. So the payout multiplier, if you remember from the previous slide on Vega 14, was 200%. So 3% times 200, that's a 6% adjustment. This is what it's going to do. We're taking the old payout, we're adding 6% to it, and the client's new income is now $17,107. You can see what some really good years can do. Look at this one, a 20, almost just over a 20 and a half increase in income. So increasing income can certainly help your clients grow their income over time. It starts out a little bit lower, but the power of that multiplier is very effective to grow that income. Now on level withdrawals, just like the name says, there's no trick to it. Level withdrawals remain level. All right, same waiting period as we saw before, 7-year wait on the 7 and a 10-year wait on the 10 and 14. The level income will start out at a little bit higher than increasing, but it will not increase. All right. So here's an example, same premium, same client, same deferral period. Client says, hey, I waited my 10 years. I want to turn on income. Benefit value is $358,625. The payout percentage is applied. Boom, the client's going to start receiving $17,931. Guess what the income's going to be the next year? $17,931. What about the next year? $17,931. So level income is for those clients that want stability and there's no change whatsoever. It's going to remain level once they start taking that income. Our wellness withdrawal feature is available on both increasing and level. It works the same exact way as we talked about on Denali. It is strictly ADL driven. It'll enhance the income for a maximum of 5 years. It'll double the income on a single payout, and it's 1.5 times on a joint. So only available on level or increasing income on Vega. Now, accelerated withdrawals. This is the first of its kind. We don't think anybody else has it. At least I have not seen another contract that has this type of feature. The same waiting period applies on this benefit, but what the accelerated withdrawals do is it says, hey, you have Mr. or Mrs. Client, you have this benefit value over here. All right. And the client says, I want that benefit value, the max amount possible over the shortest amount of time. Well, we can do that. The Vega plan allows for that benefit value to be paid out over 10 years. The bonus plan will take that benefit value and pay it out to the client over a 15-year period. Let's take a look at an example. We're looking at the same $100,000 initial premium, 10 years of deferral. Our benefit value has grown to $358,625. The client raises their hand. They say, hey, I want the most amount of income. I want accelerated withdrawals. Perfect. You can have it because you waited 10 years. The client's going to start receiving $35,863, and that's going to pay out for the next 10 years because they were in the Vega 14 chassis. Now, one thing to note, all right, if you look at year 15 here, the account value is 0 and the benefit value is 0. If the client dies, all right, and the account value and benefit value is 0, the contract is done. There's nothing left for the beneficiaries. Now they are still getting more premium or more money back than what they put in. It's just the benefit value is not fully paid out. Unfortunately, that is not continued. Okay. So pay close attention to those accelerated withdrawals and how they work and maybe the age of the client. But again, it is going to pay out more than what they put in. And it's a great way to get the whole benefit value out over the shortest amount of time. Now, the enhanced death benefit, this is another feature that adds flexibility for the beneficiaries. The beneficiaries can take the enhanced death benefit and it will pay out whatever the remaining benefit value is over a 5-year period. If we take that example of the increasing income that we looked at before, we're going to assume that the client turned on increasing income and they passed away in year 16. Well, the beneficiaries can take the account value as a lump sum, which is almost $86,000, or they could choose to take the remaining benefit value of almost $240,000, and it would pay out almost $48,000 to them for the next 5 years. So I kind of call it the lottery death benefit. Do you want a smaller amount up front or do you want a larger amount over time? It's more flexibility for the beneficiaries. It's a packed, flexible contract with 3 different income options and 2 different death benefit options as well. Now, on our case study, I think this is a real life example. We are all experiencing this right now. So Bill, he's 55. He wants to retire at 65. He's extremely concerned with cost of living. It keeps going up, but he also wants to provide a legacy to his family if possible. He's okay with receiving a lower income because he knows the opportunity with the Vega contract. All right. So what can we do for Bill? Well, one of you awesome Secure Insurance Group advisors said, Bill, I got the perfect product for you. Silac has the Vega 10. We should look at that with increasing withdrawals. Here's what it's going to look like when you run an illustration. So Bill, if you put $100,000 in this contract, here's what it's going to look like. If it could grow to $283,000 in the benefit value. Now, Bill, your benefit value is your driver. This is what allows you to turn on income after you wait the 10-year period. If we waited the 10 years, Bill, and your benefit value grew to that level, you would start receiving $11,352. But because of the awesome interest credits and opportunity of growth in this contract and the multiplier, Bill, on the Vega 10, you could see increasing income. So your next year, you could start receiving $12,163. But take a look at this, Bill. This thing still continues to grow throughout the life of the contract as you remain living. So at age 90, your income could be almost $63,000, all off of a $100,000 premium. Now, your account value and benefit value may be zero, so there wouldn't be anything left for your beneficiaries at that point. But $100,000, you withdraw $140,000 from this contract. That's a win-win, Bill, right? To guarantee an income, the opportunity for increasing, and oh my gosh, look at that leverage we can do off of a $100,000 premium if you look at the total withdrawals. So Vega is a really good story for that increasing income. Now, another play that I want to mention before we go just on our brief highlight of proprietary indices is Vega has that death benefit, okay? That death benefit goes up to age 90. There's no cap on it whatsoever. So think about those clients that maybe have got declined for life insurance, or they're a little bit older and life insurance is too expensive for them. They could put that money into Vega, not touch it with the power of the multiplier going into the benefit value. Their beneficiaries could have a pretty nice chunk of change, whether it be a lump sum account value or a 5-year payout on that benefit value. All right. So again, not only is it focused on income, it could certainly be used as a death benefit play as well. Now, it's not tax-free because it is an annuity, but a great way to help grow an estate for somebody that's uninsurable. Just real quick on our proprietary indices, I want to just cover this real quick. Atlas is our global index. There's no fees for this. It's a 1-year strategy. It's available on all of our annuities. However, it can't be illustrated in a few states. Unfortunately, Missouri is one of those. But for more information, check it out. It is a volatility control index, and it rebalances itself daily. All right. We have a ton of information on our microsite, which I'll share with you in a minute, but just want to recap on our Atlas strategy. And also, if you're appointed with us, there's more information on the Atlas strategy on our agent portal. On top of that, Raven Pack is our other proprietary index. Same way. All right. This index went live in 2017. It's a 1-year strategy. Again, no fees in the same states. It can't be illustrated in, but it is available wherever our products are available. Now, going into some resources to help you grow, as I mentioned before, we have this microsite. If you're not familiar with it, check it out. It is super simple to use. If you're on the go, on the fly, you need a brochure, you're sitting with a client, this is a great resource for you to pull something up without having to log in. You can click the brochure, you can go over our proprietary indices. It is there for you to use to pull up quick, fast resources. All right, that website is silacins.com/Silac. So take a picture of that, do whatever, but it's a great resource for you to utilize on the go. There are marketing pieces that are being added to this, especially this month for Annuity Awareness Month. So we are coming out with brand new pieces that show how we can position some annuities in some unique ways. and also some really cool marketing pieces that really can explain the benefits of repositioning assets into an annuity and how they can really help clients. As I mentioned before, our case studies are published. So if you want to see more of these case studies, check out our agent portal. They are available. They're simple 2-page little case studies that are there. It gives you a setup of what the client is looking for and how our products can achieve and fulfill that client that client's wishes with their funds to set them up for a better retirement. Now, our sales library, the annual review piece is one of probably the most important pieces. All right. This annual review piece, I can tell you, we get emails on a weekly basis in our sales team inbox of agents emailing us saying, hey, we used that annual review piece and we uncovered some hidden assets we didn't even know the client had. All right. It's a great way to get in front of your clients. It's even if your clients don't even have a Silac annuity, you can do this annual review with any type of annuity, but hopefully, right, by going through this review packet, you can make sure that not only is their current annuity doing what's best for them, and if not, we can look at other alternative options to make sure it's doing what exactly it needs to be doing for them to set them up for a better retirement. Just real quick, we are doing a player circle trip, Tanzania, 5 million top 60 producers to get you 2 tickets to Tanzania. I don't know a lot about it. I know it's in South Africa and there's elephants there. That's pretty much all I know. But anyways, we do offer these incentives, and this is for the production of 2022. That trip is going to happen in May of 2023 next year. Now, before I release anybody and answer any questions, I want to leave everybody with a sales idea. Okay, I think this is extremely important. We talked about how these products work. We talked about how positioning some of these products, but we need to talk about just a little bit of maybe a sales idea. So I want everybody to try this, okay? And this is a guaranteed lifetime income sales idea that I personally use, okay, for my own clients. But when I sit with a client, I ask them these 3 simple questions. Number 1, Mr. Retiree, when you retire, how long do you want your retirement income to last? I pause. I let them answer it. Okay. Number 2, do you want your retirement income guaranteed? All right. Of course, they're going to say yes, right? And number 3, is your retirement income guaranteed now? Well, if not, maybe spend some time with me so I can show you a product that offers no downside risk, tax deferral on accumulation, and guaranteed income for life when you retire. All right. So I hope this helps you. I hope this helps everybody, but this is a great way to set up a conversation with somebody to hopefully talk about either our Denali contract or even our Vega contract to show a client how we can guarantee an income stream in retirement. So with that, I want to say thank you, Matt, or I'm sorry, Dallas. I believe I got done way short of time just for you. But I will answer any questions that we have on the call today.
I have a question.
Yes.
Where can we go to look at this again?
So I believe this is going to be recorded, and I believe Secure Insurance Group has a portal or someplace to store these recordings. We also do these every Monday, and we house all of our recordings once you get appointed with Silac on our agent portal, where you can view any of our Monday morning webinars, which are similar to this.
Wonderful. Thank you.
You're welcome.
I have a question.
Yes.
I am 100% brand new to annuities.
Okay.
And I need some annuities for dummies. What would you recommend?
Yeah, so we actually have a couple pieces on our agent portal that one is an annuity 101 sheet that kind of explains the benefits, the pros and cons of how an annuity is structured. We also have a client-friendly piece, I think, and from an annuity 101 standpoint, to get a brief introduction, the how your annuity will grow piece would be a great start for you to read. That kind of shows you the backdrop of the annuity, what the annuity is designed to do, how it grows from the different indexing strategies, how they work, and then the opportunities that the certain contract can allow. So that would be another good way to start. I know YouTube has a bunch of various videos out there. If you just type in annuity 101 training, I know we can jump on a call if we want to arrange a call with either Dallas or Secure Insurance Group or somebody. We can, jump into some annuity 101 basics. We can go over that as well. And I would recommend, once you get a good understanding, the best thing that worked for me is after I got a good understanding of how the annuities worked from a high level overview, as boring as this sounds, I actually read a specimen contract. And that was probably the best thing I ever did to get me going, but completely read a specimen contract of an annuity. And it really set me up, because what you're going to find is all of these annuities work the same. They just have a few extra, nuts or bolts here, nuts or bolts there, but they're all built on the same chassis.
So those trainings that you mentioned on the website, are they on the Secure Insurance Group website? Is that what you're talking about?
The trainings I was mentioning are on the Silac portal.
Okay.
Yep.
All right. And that last item that you mentioned that you read, I forgot what kind of contract you called it.
Yeah, a specimen contract. It's just
Specimen contract.
it's just a sample contract. All the language and verbiage of the annuity contract, exactly what the client would receive. Those can be found on our agent portal as well. And after this call, what I can do is I can send a generic one over to Dallas just for our Teton contract. I think that would be the easiest way to start. And then he can distribute that out to whoever may need it.
That would be great. Thank you so much.
You're welcome.
I have one question. I apologize if you've covered it earlier, but I was wondering if these products are first in, first out, or last in, first out.
For as far as income is concerned,
Correct.
yeah, all of our contracts are LIFO, last in, first out.
Thank you.
Yeah, it's very rare to find an annuity with FIFO anymore. I don't know of any annuities out there that are FIFO built. Most of them are going to be a LIFO chassis. Any other questions? These are some great questions. Any other questions?
That's it.
That's it?
I think so.
Awesome. Well, I appreciate everybody. Thank you for asking those questions. I always like being asked those questions. Those are great questions. And if there's any way I can help anybody out, please let me know. Let Dallas at Secure Insurance Group know, and we'll be happy to get you started and hopefully write some Silac annuities.